Welcome to our 2022 webinar series, Risk Management with Insurance in a Post-Pandemic World. The COVID-19 pandemic taught us to adapt and accelerate trends socially, technically, and environmentally. As we inch into a post-pandemic world, risk management continues to be top of mind for most of us. Each month, you'll learn about insurance solutions you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. Today's webinar will be recorded and posted on our website within 24 hours. Today's presenter joined LLIS in 2003, assumed the role of president in 2008, and CEO in January of 2013. He continues to monitor the insurance and financial services industry to provide you and your clients the most up-to-date recommendations. Here to present Leaving a Legacy with Life Insurance is Mark Maurer.
Thanks, Claudia. And yes, 2003 is when I started, and I looked quite a bit younger than I do in these new pictures, but that's been almost 20 years, so I guess that's to be expected. Thank you, everybody, for tuning in. Hope everybody's enjoying their summer, hopefully some summer vacations. Either you've had them, you're having them, you're going to have them. So hope everybody's is going well. And today we're going to talk about leaving a legacy. We talk regularly about term life insurance for income replacement, our income earning years, or disability insurance to replace that lost income. But sometimes we have a need for wanting to leave something to somebody, not just in my income earning years, but maybe whenever I pass away. And so when we start talking about legacies, there's a few things that come to mind. First off, well, the Marvel Legacy movies. That might just be me, but my family's a big fan of the Marvel movies, and they have the Marvel Legacy, which seems to just mostly be the X-Men movies. But that might be a legacy to you. In the insurance world, anytime we try to make changes or do something with older policies, we're told it's legacy systems that prevent us from making any changes. And so a lot of times I think of Milton from Office Space, just somewhere down in a basement with those giant computers and saying, no, that's legacy systems. We can't do anything about that. And then, of course, putting your name on a building. That's a great way to leave a legacy. Usually requires a whole lot of money, but that's a way you can leave a legacy. Have something named after you, and that's not a bad option either. So, not unlike the legacy of putting your name on a building, it takes money. And most often when we talk about or think about leaving a legacy, we think of it in the form of money, something we leave to somebody. Well, you can leave assets as a legacy, whatever you've got built up in your portfolio today. But if you want to make sure that you leave something to somebody, then you can't spend down all of your assets. You can't spend all of your money and have that last check bounce. So sometimes you have to hold assets aside or think about not spending everything down if you want to leave a legacy. How do you split a business? Maybe you have a family business and some children work in the business and some don't. You may not want to give equal shares to kids who are in the business and who aren't. Even a more specific example, how about a farm? One child's working the farm, running the farm, and somebody else isn't. Do they want to then become both co-owners of the farm? You can leave life insurance. Which, being in the life insurance world, I think is a great way to leave assets. It allows you to spend down all of your other money. Let that last check bounce. Cash is a great equalizer. You can leave one child a business and one child cash. Leave one child a farm, one child cash. Very nice way to equalize things. And then there's some tax benefits too. Life insurance passes income tax free to beneficiaries. And we're going to talk shortly about maybe some estate planning ways to not have it included in your taxable estate. So we're going to talk about life insurance and the idea of sort of using gifts to help prevent any estate tax issues, leaving life insurance to a charity. And then we're going to talk about some hybrid policies. So these are life or annuity policies that combine a long-term care benefit with life insurance. You end up leaving that as the legacy. With the long-term care plans, you access that policy to pay for care to leave other assets. How about leaving qualified money to your kids, to your beneficiaries? In the not so recent past, the Secure Act changed some of those rules. And so really no more stretch IRA rules. Non-spouse beneficiaries have to take that money out over 10 years. And so that can cause some big tax issues. So, really, who's it not going to impact? Small IRAs. When grandma leaves a $100,000 IRA to the 3 grandkids, they weren't necessarily the people who we were looking at for stretch IRA planning anyway. They were just going to take their money and run. They weren't going to stretch their $33,000 over 30 or 40 year life expectancies for $1,000 a year. They're just going to take that out. But larger IRAs, $1 million or more, they weren't great for estate planning to begin with. They can be in trusts, but that got a whole lot more complicated here in the last little bit. Taxes are still due. There's some distribution rules. So not great as a way to leave significant money to kids. One idea, though, is if you have a legacy goal, legacy desire, then you can leave qualified money to the charity, to a favorite charity. Charities don't pay tax. And so it's just a neat idea. You can leave the other assets with a step up in cost basis to the kids, or leave life insurance. Thought I'd get that in there one more time. Sometimes people think of leaving annuities as legacies. And if clients have existing annuities, they may or may not need to access them for the cash values in life. And it's a way to potentially leave money to them. So that's going to be okay. And what are some of the things that make it okay as a way to leave assets to somebody? An annuity has named beneficiaries. So it's very clear who gets what. So that's a pro to leaving an annuity as a legacy. Also, because it has named beneficiaries, it passes outside of probate. So annuities, that's another benefit. It's not lumped into all of the probatable assets, and so it passes to beneficiaries. So it's a way to have assets pass outside of probate. Some of the cons, though, to leaving an annuity as a legacy is that for non-spouse beneficiaries, any gains in the annuity are taxed as ordinary income. So if someone put $100,000, there's a $100,000 gain. When it's time to pass on to a non-spouse, that $100,000 of gains is going to owe, the beneficiaries are going to owe ordinary income tax on that $100,000 of gains. And if under the 5-year distribution rules, the beneficiaries want to take money out, they're taking out all the gains first. An exception would be using a non-qualified stretch annuity, where you can stretch it out over longer than 5 years, but you still owe tax on the gains. You can even do the beneficiary could even do a 5-year immediate annuity and spread the payments out over 5 years. Each part of each payment is going to be part tax-free return of basis, part taxable gains, but still going to have to owe tax on those gains. We can maybe spread them out, do different things with them, but the IRS cometh for their tax on those gains. Which leads me to life insurance. One of the same pros as an annuity They're named beneficiaries, so there's no probate. Passes outside of the probatable estate, so you name a beneficiary, and that's who the money goes to. And life insurance death benefits are income tax free and have been for many decades. So that's a nice benefit to the beneficiaries, is that legacy then comes to them income tax free. And with the proper design, it can be estate tax free. I still talk about estate tax planning, even though under today's rules, you need to have an estate of 20 million plus for a couple. But as we know, all of the estate tax rules, estate limits are only as permanent as the government plans on it being permanent. So at any point in time, we probably can look at different numbers and know that they're higher than when I started, where an estate tax was $1 million. But what are those numbers going to be in the future? So sometimes designing today, assuming that maybe estate tax limits, the limits will be lower so that more people will have an estate tax issue, might make sense. So let's look at an idea. So here's Jocelyn and James. They have 3 kids, Joan, Jimmy, and Jack. They're starting to look at estate planning. They're retired, newly retired. They've done well for themselves. They have about $4 million of spendable assets today. They have some money in their IRA that they plan on living on, or they might be able to access. No debt. So they have about $4 million of spendable assets today. But one of their planning goals is they want to leave at least $500,000 to each child. So 3 kids, that's about $1.5 million. So as part of their overall plan, and using a very simplified estimated retirement planning horizon tool, this was Vanguard's retirement nest egg calculator. So amazingly overly simplified, but gives a point of reference here. If we want their $4 million to last 35 years, and they're spending $120,000 a year in a 60-40 split, and remember, I'm not a financial advisor, so some of you may be saying, well, that's not what I would do. Actually, most of you might be saying that's not what I would do. Just go with me here on sort of my big picture idea. And then if you want to tell me later how you might do it, I'm happy to listen. So under that assumption down here in the bottom right, it gives a 97% chance that they're not going to outlive their money. That sounds great. If everything in the world I could have a 97% chance on, that would be pretty awesome. But that assumes that all of that $4 million is spendable, livable on-able, not exactly a word, but that they can use all of that. And using that $4 million, having 100% access to that, we get that 97% calculation. So everything looks good today. But we have to remember that without doing anything else, they wanted to make sure that they passed on $1.5 million to their kids. So they can't spend all of that down. So the safest, probably the, again, overly simplified version would be they need to isolate some ball of money today and put it in something very safe, potentially cash. They have to isolate it, put it in a lockbox over here, and say, we can't touch that because we want to make sure we leave our kids 1.5 million. And using, I looked up some rates for online savings accounts, 1.4%. So over 35 years, they need put about $1 million today into that savings account to have the 1.5 million in 35 years when we're kind of assuming they've passed away. Now, if they pass away earlier, they may need that, but maybe they haven't spent down as much money. But the idea here is that in order to make sure they leave their kids 1.5 million, we have to earmark or isolate some part of that portfolio. So using my overly simplified, they need to put about $900,000 into a savings account that'll grow to that 1.5 when they pass away. So what does that mean? That means we isolated some of that money. And so they now, of that 4 million, they have $3 million today that they can spend down to zero and still be able to leave money to their kids. Now, when we do that, using the same retirement plan calculator, once we have to take out $1 million, basically put it away, put it in a lockbox, isolate it, say, okay, we've got to make sure that we leave some, can't spend it all. We've got to put something over here to leave for them. Now, our success rate instead of 97% is 87%. You know, that's still better than a stick in the eye, but we went from 97% to 87%. We all like the 97% better. So because we were doing something safe, we needed a big ball of that money and that cash today. So then the third, or it's the second option I looked at, was what about a second to die universal life policy? So we're going to have them purchase a $1.5 million joint life policy. So when the first spouse passes away, there's no death benefit. The death benefit comes into play when mom and dad have both passed away. By doing that, by covering or spreading that risk over 2 lifetimes, we get the most bang for the buck when our need is something like just wanting to make sure we leave money to the kids. Doesn't have to be at mom's death or dad's death. We leave to our kids. Same idea for estate taxes. Not due at the first spouse's death, but due at the second spouse's death. So when we designed that, I also designed it to have premiums under the annual gifting. And we're going to talk about why we might want to use annual gifting later. But just from the standpoint of today, how much do we need for those policies? I looked at a few different companies. So about $83,000 today for 5 years is going to guarantee that $1.5 million death benefit in the future, whether that's 20, 30, 40, 50 years from now. We've taken $415,000 to provide that $1.5 million. So instead of isolating $900,000, now we're isolating $415,000 to provide that same $500,000 per child whenever mom and dad pass away. So that means instead of having 3 million of my 4 million that's spendable, I have about 3.5 million of that 4 million that's spendable. And if we look down here in the bottom right, it's not quite 97%, but we're back to 94%. Went from 97 with no money to the kids, or there probably would be, but 97% sure that $4 million is going to cover everything they might need. 3 million, we went to an 87%. We bring it back to 3.5 million. Now we've got 94%. I like 97 or 94%. If I could get anything in the world, if I had a 94% chance of success, that's pretty good. So sort of an overly simplified way of thinking about this, but if clients say, I want to make sure I leave a legacy, then taking some money now provides a much bigger death benefit. And instead of isolating $900,000 today that they really can't spend, or knowing we can't spend all of our money, this takes a smaller bucket of money to provide that legacy, leaving $3.5 million in this case for mom and dad to spend instead of $3 million. that they can spend with impunity. Now, who should own the policy when we're talking about a legacy? We can own the policy, we can have mom and dad own the policy, or we can set up an ILIT, an irrevocable life insurance trust. So when mom and dad own the policy personally, they own it, they have full control over it. When they pass away, that death benefit is included in their taxable estate. Again, for Jocelyn and James, $4 million at a $1.5 million death benefit. We're way under the $20 million plus rules today. Those can change, but even if it were 3.5 per person, which I've heard some numbers are 5 per person, we're still under that. But to set up an ILIT, the ILIT has its own tax ID number, it has a trustee, so it's separate from the insured. And effectively, you create this trust. The trust is the owner that owns the life insurance policy on Jocelyn and James. What Jocelyn and James do is they make gifts into the trust. Now, the trustee every year has to send out crummy letters. And this is an IRS rule that creates, that turns present value or future value gifts into present value gifts. Effectively, the trustee says, you were gifted money into this policy, into this trust. You have the ability to take the money out, but if you don't, we're going to leave it in here and pay the life insurance. Hopefully all the kids say, leave it in, what they're supposed to do. And then the trustee, when that period expires, then the trustee pays the premiums to the life insurance company on behalf of the trust. So a few different steps there that have to work, that have to go in a certain order to create that present value gift. But there's some benefits to it. Because at death, now that death benefit, it's held by an ILIT, it's held by a trust, it has its own tax ID, it's a separate entity. That death benefit is not included in Jocelyn and James's taxable estate. So they were able to both reduce their taxable estate by making gifts out of it, plus the death benefit is not included in their taxable estate. So estate tax free and income tax free to the beneficiaries. The trust is both the owner and the beneficiary. So the death benefit, that $1.5 million, is paid to the trust. And then the trustee disperses the life insurance proceeds to the beneficiaries through the trust provisions. So lots of different pieces, moving parts here. But all of those go to create some rules, and we get that removed out of their taxable estate. So what are some pros and cons to having it personally owned? Well, if they own it personally, the proceeds still pass income tax free to the beneficiaries. That's in either scenario. So again, under today's estate tax rules, the ILIT doesn't have quite the shine and the glitter that it did when we had much smaller estate tax limits. But a benefit here is that mom and dad get to keep control. They can change the beneficiaries. So you always want to be on mom and dad's good side if they can control and change the beneficiaries. The downside here, death benefit included in the taxable estate, which for lots of estates may or may not be a concern. What are some benefits to the ILIT? Well, with the trust, mom and dad get to do a little bit of controlling from beyond the grave. Because the money goes into the trust, there's a trustee who has the ability to disperse the funds, but they have to follow the trust guidelines. So if you have minor children, you can't just give minor kids $1 million. So there's a trustee who can manage for health, education, maintenance, and support until they reach 18 and then pay for college. And then at 21, they can get a third of the residual, and 25, the last third, and 30, the remainder of the residual. Set up lots of different things. So that's great for type A's, type A personalities. If mom and dad really want to sort of control the kids' lives from beyond the grave. also protects spendthrifts. I'm sure we all know people in our lives who spend money as quickly as they get it. And so having the trustee who can manage it and spread it out for a long period of time may be very beneficial. Death benefit removed from taxable estate, always a plus. Some of the reasons that like I talked about, some of the sort of complicating factors for the ILIT, there's an attorney to set up the trust and distribute and manage the crummy letters every year. Do you have a good trustee? May not want to name one of the kids a trustee. You may not want to name the responsible kid as a trustee who has to manage the funds for the spendthrift sibling, because that's not going to necessarily create a good family relationship over time. If your trustee is your grandpa, you're more than likely going to outlive your grandpa. So, then you have to deal with that later in life. And once it's gifted, it's gone. So all those gifts, once they go into that trust, the kids could say, give me my money. I don't want it to go to the life insurance policy. Now that's just something that, you can kind of fool me once, shame on you, fool me twice, shame on me. You can gift it into the trust one time and they can take the money out, but mom and dad don't have to gift it again if the kids aren't following the rules. And then there's something called a poor man's ILIT. Instead of having an ILIT, the whole trust, the children apply for a life insurance policy on the parents. It accomplishes a lot of the same things. So parents gift the premiums to the adult children to pay the life insurance company instead of gifting it into a trust. The premiums are gifted out of the estate, whether it's in an ILIT or directly to the kids. The death benefit was never in the parents' estates because the kids own it or an ILIT owns it. So it really accomplishes all of the same things, but the same warning as before. Remember, once you give it away, it's gone. So this would be ideal for responsible children, maybe children whose siblings or significant others and children that the grantors like. With the ILIT, you can control a lot more if maybe there's a divorce or family situations that mom and dad aren't exactly, a spouse or a partner that mom and dad don't particularly like. In this scenario, once each kid owns the policy and mom and dad are gifting the premiums there, they really don't have any control. The kids own the policy, kids control the policy, and they can name the beneficiary to whoever they want. So that's sort of the legacy I think that we all think of, really leaving, for most of us, leaving money to our kids. But what about a public legacy? Like having our name on the building, sometimes we want to leave money to our church, our synagogue, our college, our local food bank. So why does life insurance work well? Well, like most things, it provides money to a named beneficiary at my death. Right when I pass away, that's I think when a lot of us think about leaving our largest legacies, not during life, but at death. And so it accomplishes all of that. It's tax-free at death. There's a great IRR on the premiums to the death benefit, especially if there's an early death. It's stable, it's predictable. For Jocelyn and James, they put in $400,000 to guarantee $1.5 million for their lifetimes. It's exactly what it's going to be. No correlation with financial markets. If the markets are down when mom and dad pass away or the grantors pass away, the death benefit is still whatever it was when the policy was fixed, still that $1.5 million for Jocelyn and James. Why are we talking about public legacies? Because Americans are generous. In 2015, these are from Charity Navigator and the most recent numbers I could find, 773 billion in 2015, 410 billion in 2017. So we're giving billions of dollars to all of these institutions. One of the questions is the survivorship policy truly guaranteed, or is it possible for the policy to get a cash call late in life to keep it in force? There's a number of different types of policies, and sometimes with either index universal life, variable universal life, cash value design policies, you make certain assumptions on how long the policy will last. In this particular scenario, what I use is what's called a no lapse guarantee policy. So from the get-go, there's a fixed death benefit and a fixed premium for a certain amount of time. And so with that particular policy, there is no chance that premiums are going to come back later in life. So it's set up from day one that as long as you pay, I think the $83,000 for 5 years, that death benefit is guaranteed to age 100, regardless of what happens. So thank you for that question. So it just depends on the number of different types of policies, but in my particular example, is truly guaranteed for life. So why would we use life insurance for a public legacy? We're going to talk about leveraging, discounting, replacement, and recognition. So leveraging. The death benefit is always going to exceed the premiums paid. In my example before, Jocelyn and James put in $400,000 to guarantee a $1.5 million death benefit. And maybe $400,000 doesn't sound as much as they would like to leave at some point in time. But $1.5 million sure does. Sounds, just exciting. Discounting, sort of the same idea, death benefit exceeds premiums paid, but, and kind of goes into number 4, a lot of charities, a lot of recognition groups are, your donor level is based not necessarily on what you put in, but potentially the amount of the gift. And so clients may be able to put in $200,000, but get recognition for a $500,000 gift. Replacement, in this case, it replaces assets that could have or would have gone to family members. I want to make sure that I leave money to my kids, but I also want to make sure I leave money to the ASPCA. So I can segment out dollars here, dollars there, and setting that up today protects that legacy. So in Jocelyn and James's scenario, if they did use up all of that money, by setting up a life insurance policy to pass on to a charity today, prevents from some point in time saying the kid's getting some money and saying, oh, there's not enough to leave money to the ASPCA. And then the recognition, naming rights, donor category. Lots of places you're recognized for the deferred gift today. And so you may fall into the, look down on that graphic there, really small. There's a $500,000 to a, for some reason, $1.1 million giving level, but you may be able to be in the $500,000 level, but you didn't pay $500,000 because the life insurance death benefit is $500,000. So that might get you better seats at the football game. There is some extra underwriting, not a lot, but insurance companies want to know if I have traditional life insurance on myself or my spouse, it's for income replacement. Why am I doing the gift? Is there a particular reason, a particular thing I'm trying to match? Has there been a history of giving? Is there an insurable interest? Is there a particular reason why this particular charity? And we're going to talk about whether is it better for the charity to own the policy or not. That's something to find out if they'll even accept an insurance policy. Now, they'll always accept being the beneficiary of a policy, but if I wanted to gift or have the charity be the owner of the insurance policy, will they allow that? Because here's the 2 different reasons on why either we'd have the charity as the owner of the policy or keep the client as the owner of the policy. When the charity is the owner of the life insurance policy, they also name themselves as a beneficiary. But I get to, me being the client, me being the grantor, get to deduct the premiums now. So I write my checks to Metropolitan Ministries, which is a charity here in town that we do holiday volunteering with. If Metropolitan Ministries owns the policy, then I make my gift to Metropolitan Ministries directly. So now I get to deduct it. I can do a single premium or short pay. You want the charity to be long lasting, of course, and I can't undo it. The Metropolitan Ministries owner beneficiary of the policy, once I gift them that first year premium or single premium, I can't get that back. So John donates to Metropolitan Ministries. That's a deduction right there. The Metropolitan Ministries gets his check, and then they write the premium check right back to the insurance company. Or we're going to keep John as the owner. So he's going to be the owner insured, and he just names the charity as the beneficiary. That $100,000 policy, death benefit, if he passes away, that $100,000 is included in his estate, but it comes right back out as a charitable donation, so it's deducted at payout. So it doesn't really impact his taxable estate. And again, he can do whatever he wants with the policy. The key here is that the premium is not deductible. So if the charity owns the policy, I get the benefit of the deduction for the premiums. If I own the policy or John owns the policy, he doesn't get to deduct the premiums, but the death benefit is deducted from his taxable estate. Again, with $20+ million, it may be more advantageous to have the charity own the policy to get the current deductions. But if John doesn't like the way that the charity starts running, he can change his mind. He can name a different beneficiary. He can say, I don't like what they're doing anymore. Or, they don't exist anymore. I'm going to name a different beneficiary. He can even divide it between charities. To divide it between charities, if the charities own it, well, he needs lots of different policies. So John pays the premiums if he owns the policy. It's not deductible. Pays the premiums directly to insurance company for a policy he owns, and when he passes away, he can say, I want 50% of it to go to my university and 50% of it to go to Metropolitan Ministries. His estate gets the charitable deduction, but didn't really do anything for him in life. So those are ideas with traditional life insurance, and we're going to talk next about the long-term care hybrids. So with life insurance, we sort of say, I'm going to spend all my other money, and then I leave this life insurance to a charity to my kids. Sometimes clients may or may not be worried about truly running out of assets, but say, if I have a long-term care need, if I have a long-term care event, I want to make sure that there's some money left over. Maybe they don't have a specific amount, $500,000, $1 million. I just want to make sure I leave something to my kids. I'm worried about leaving enough behind. Enough is a very subjective word. It's not specific, but I'm worried about leaving enough, or it might just be I'm worried about leaving something. And if the client has a long-term care event and long-term care needs, that could use up a lot of assets. And people use long-term care. Men on average need assistance for an average of 2.2 years, and women might need it for 3.7 years. And it's not inexpensive. Median annual cost of a private home and a nursing room, over $108,000 a year. Annual cost for a home health aide is over $61,000 a year. So if someone has 3-4 years of care, that can be $250,000, $400,000 that they used up of other assets. They may not think of themselves as someone who needs to leave $1 million or $1.5 million, but I have some money over here, I have some money over there, and I don't necessarily want to use it all up if I needed care. Half of people over age 65 will incur some long-term care costs, and 15% are going to need to pay more than $250,000. Let's look at a life long-term care example. Here's Terry. She's age 65, has some Prudential whole life policies. She's single, has minimal life insurance need, not a big estate planning goal, not a desire to leave anyone $1 million or $3 million, but wants to leave her kids something, make sure something's there. Long-term care is a planning concern as you've met with them. The kids don't live close. She's single, so if if she had a care need, there's not a spouse, a partner in the house who can help provide some of that initial sort of hands-on care, that home type of care. So if she needed care, she's going to probably need to start paying for it very quickly as compared to someone who has a spouse or partner at home who can do a lot of things initially. Her 3 Prudential whole life policies, she has about $700,000 in cash values in the policies. There's 2 general designs for life insurance long-term care policies. We can either have it designed more for the life insurance or more for the long-term care benefits. We're not going to talk about the life insurance particularly for her because that wasn't really her planning worry. We're talking about the long-term care benefits of the policy. And so we can design these life insurance, hybrid life long-term care policies to make them look like, smell like, taste like traditional long-term care policies. And no, I don't know what a long-term care policy actually tastes like, but it's going to be pretty much the same. Monthly benefits, it can have 4 years of benefits. It can have an inflation rider. And in general, it's going to have this larger long-term care benefit pool that's growing every year and a fairly small death benefit. So if she doesn't use it for long-term care, there's a death benefit that passes to her kids. But in case she needs care, being single, far away from the kids, that's a bigger worry that she might incur. She might be one of those 15% of people who has that $250,000 need. So here's 3 different insurance carriers for that $70,000. If we jump to the 3rd column, if she never needs it for long-term care, the policies have either a $70,000 death benefit, basically what she paid in. Securian has almost $60,000. But for the most part, that death benefit is going to be what her premiums paid in were. Not a huge death benefit, practically none at all. It's just a return of her premium. But in case she needs long-term care at age 85, with the nationwide policy, we've got an almost $230,000 long-term care benefit pool that she can draw down on. $231,000 that's not being spent from other assets. So that's money that can be set aside for her kids, just knowing it's available there. And the residual death benefit's interesting. Again, looking at the nationwide policy. In the scenario where she spends $230,000 of the long-term care benefits and she passes away, there's still a smaller residual death benefit that goes to the kids. So potentially she can get $231,000 from the policy for long-term care benefits, and then when she passes away, her kids still get $12,000. So she was able to get almost $245,000 out of the policy if she needed it for care. So pretty neat way to take the current cash value she has and create that much larger long-term care pool. Each of those policies has some different things that they sort of specialize in. So when we're evaluating policies for clients and for you, we look at, is there an elimination or waiting period? Is a cash value, a return of premium important to the client? Do we want to maximize the long-term care benefits? And the answer is most of the time that's what we're looking for. Something else I didn't touch on is the policy a reimbursement or an indemnity type policy? A reimbursement policy does exactly that. It reimburses the insured for qualified care that they had for any given month. So if the benefit is $2,200 and she didn't use $2,200 of care in any particular month, the insurance company reimburses her what she spent, but then that unused money stays in the pool of benefits to be used at a later date. With the indemnity policies, once she goes on claim, the insurance company just cuts her a check each month for the full monthly benefit. So if she doesn't need as much as that check, she can keep it and save it for a different month. If indemnity, if she wants to be able to pay a neighbor or kids to provide some of the care, she has that option. She still has to get qualified care, in order to be able to be eligible for benefits, but just frees up whatever that check she gets to be able to spend it a little more flexibly. And the last thing we're going to touch on are annuities with long-term care benefits. So how do these work? They have the same long-term care qualifiers or triggers: the inability to perform 2 of the 6 activities of daily living or cognitive impairment. But with these annuities, once they pay long-term care benefits from the annuity, they're considered tax-free. Currently only available on single premium, non-qualified fixed annuities. And it's easy to cover spouses or partners with one policy. And this is really where I'm going to spend most of my time talking about these policies. Because what we're going to look at is doing that 1035 exchange from an existing life insurance policy or an existing annuity. Clients can write a check. That's easy. It's even easier because you don't have to worry about getting money from insurance company A to insurance company B. So that can be helpful for clients maybe who the hybrid annuity tends to have a little more lenient underwriting than traditional long-term care policies. And it's a way to be able to add both spouses on one policy. And with the annuity, it's still an annuity. So if they never need it for long-term care, there's still that annuity cash value that they can use to supplement retirement income, which we would try not to do because then you get rid of the long-term care benefits of it. But more likely, if they don't need it for long-term care, there's still an annuity cash value that passes on to their beneficiaries later in life. We have this fixed deferred annuity with a guaranteed monthly long-term care benefit, guaranteed total benefit pool, and we can add the spouse on it. So I keep talking about adding the spouse on it because my aha moment is that a lot of times when you're reviewing life insurance policies or annuities for your clients, we find out that they're really lopsided. Many times the higher income earning spouse may have $500,000, a $500,000 whole life policy, or $750,000 or $1 million whole life policy with a lot of cash values. And the non-working spouse had a $100,000 policy and maybe has a little bit of cash value. So if we were to do an exchange to life insurance, we have to have the same owner and same beneficiary. So the larger the income earning spouse would have a really big hybrid life long-term care policy, and the non-working spouse partner would have a much smaller one, and we need to add some additional premiums. With the hybrid annuity, though, we have this neat thing where we can do the 1035 exchange, take the big cash value policy and move it into a hybrid annuity where the income earner is still the primary annuitant, but we can add the spouse or partner on as an eligible person for long-term care benefits. So it's a way we can use one person's big life insurance cash value, big annuity value, and use it to create a long-term care pool that they can both use. That's really, I think that's really where this is so cool. It just really makes that issue of lopsided or one spouse partner with a lot of cash value be able to work for both. So here's Carl. He's age 62. He was declined for long-term care insurance, partly because he was 5'7", he is 5'7", 225. The picture, you know, he's maybe a little thinner than that in the picture. He's 5'7", 225, because in 2015, had gastric bypass surgery. He was 325 at that point. In 2011, he was diagnosed as bipolar. He was on 2 medications, edible marijuana once a week, and so declined for traditional long-term care insurance. But with the hybrid annuity, he was eligible. So here's a way to provide long-term care benefits when he was not eligible to get traditional long-term care. And Carl has an annuity. He's got $150,000 in cash value with a $75,000 basis, $75,000 in gains. So while Carl may have earmarked this policy in his mind, in your mind, as the advisor, for that's our long-term care fund. If he needed to pay for care out of pocket, and this is where he started to access it, that first $75,000 that he takes out of the annuity is taxed, and it's taxed as ordinary income. That annuity, when you take money out, you take your gains out first, taxed as ordinary income. So the first $75,000, half of it is going to be all taxable if he uses it to pay for long-term care. But Carl also has Carla. So he has this big annuity with this cash value. We're looking at long-term care coverage. We're looking at long-term care benefits. And we say, well, you know what? Spouses like to share everything, except maybe dessert. But maybe that's just me. So we have Carla, and we want to be able to include her in this long-term care planning. With the hybrid annuity, we can. So we have a joint hybrid annuity with Carl and Carla both eligible to receive long-term care benefits from it. So at the end of the first year, if we look in that middle box, we have $151,000 long-term care accumulated value and 182 long-term care extension. It's a complicated way that this particular annuity works, but at the end of the day, we took a $150,000 annuity and created a $333,000 long-term care pool. Now, Carl and Carla can both access that $333,000. So Carl can access the annuity for $556 a month, up to the $333,000. Same for Carla. They could actually both be on claim at the same time, each getting their own $5,000 per month. So $120,000. They could be drawing down on the policy at $120,000 a year if they both needed care. Still the same $333,000 pool. So if they're both drawing down on it, it will get spent up twice as quickly. But we have this $333,000 pool that one or both can draw down on up to $5,000 a month. So we leverage that $150,000 to $333,000 of long-term care benefits. So how does this work? We're going to fast forward 20 years, and one of them is going to go on claim. So let's say it's Carl. With the annuity, the annuity cash value and the LTC accumulated value are kind of the same. I wish they were the same. It would make this a lot easier. But on that first column, we see that they had a cash value of $145,000. They used $63,000 through long-term care benefits. So if for some reason they wanted to surrender the annuity, there would be an $82,000 cash value. So the long-term care benefits come out of the cash value dollar for dollar. It also comes out of that long-term care accumulated value dollar for dollar. So it reduces that from 158 to 95. So they took $63,000 out of the slightly higher $348,000 long-term care pool because it's grown a little bit over the last 20 years. So after getting $63,000 from the policy to pay for long-term care, they could surrender it for $82,000 or have an $85,000 remaining long-term care pool that's available to use in the future. Most of the time, this is not where somebody should want to surrender a policy. If Carl's already on long-term care claim, you don't want to surrender this policy for 82. You want to keep it because you've got $285,000 of additional benefits out there. I mean, that's why you have this policy. So after 2 years, what happens? Another $63,000 comes out. If they wanted to surrender the policy, they've used up $126,000 out of the policy. They can surrender it for $18,000. Not going to do that. Don't. Please don't. Because he'll have used 2 years of benefits and still has $221,000 in the long-term care pool. Almost $222,000 that's available for use. So That's sort of the way this policy works. Once they start accessing it, the cash value goes down dollar for dollar, and that big long-term care benefit goes down dollar for dollar. So if we'd done year 3, we would see that he takes out another $63,000. His cash value goes to 0, but still has hundreds of tens of thousands of dollars of long-term care benefit remaining in the policy. So that's the real exciting thing about this. Is it could have been Carl, it could have been Carla, it could have been both of them, and we would have doubled the $63,000, and there'd still be some money left in the long-term care benefits after 2 years. So that's the really neat thing about this policy, because it preserves this $330,000 from being spent down. They weren't in a scenario where they said, we want to leave our kids $500,000 or $1 million, but we just want to know that we would be able to start using assets. One question. So in year 3, would he just start to use the LTC extension pool? Absolutely right. So if I'd done year 3 and he'd used $63,000, you'd see that the $31,000 accumulated value would go to 0, and then the other 30,000 and change would come out of the LTC extension policy. So if they use the annuity for long-term care benefits, all that money comes out tax-free as compared to the tax treatment where you take the gains out first, which actually would be LIFO. Less underwriting for Carl, and they get to share the policy. We took his annuity values and created a big long-term care benefit for both of them. One question, for an older client age 65 who wants to leave a legacy, would it be better to buy a 25-year term or a whole life policy? If I had a crystal ball and knew exactly how long that person was going to live, I could tell you exactly what would happen. So at age 65, I'm not sure that most insurance companies are going to offer a 25-year term. A lot of companies may start stopping that around 50, 55, maybe 60 for almost that exact reason. Their term policy is really not necessarily designed to be around for as long as somebody might be around. So if a 25-year term policy is available, we're making the guess that they're going to die before age 90. If they live to 91, that term premium is going to skyrocket if they need to keep it another couple years. So at that point, for somebody age 65, a whole life, no lapse guarantee, some sort of permanent life insurance policy is going to be able to make sure that they're not going to outlive that policy. So if we could do a 25-year term on a 65-year-old, we're sort of guessing that, it sounds weird to say hoping, but at least for the life insurance policy, we're hoping they don't live to 90 so that there would be a life insurance death benefit payout. So I hope that helps. If you have any other questions? I got 1 minute left. So I'm keeping an eye on the box here, but so just some things. If you haven't tuned into a lot of our webinars yet, hopefully you keep coming back, and we're going to have a few more through the rest of the year. Jenny Stiles in our office next month is going to talk about underwriting challenges and best practices for getting in your client's insurance. And so this is something that we do every month in addition to our LIS Academy in February here down in Florida. So come down and you can do 2 whole days of insurance webinars, but webinars in person and in Florida in February. Okay. So what do? We work with fee-only advisors only to help them with insurance designs, ideas for their clients, help try to save you time and clients money by doing a lot of pre-underwriting to avoid surprises. We have specialists here in our office in life insurance, disability insurance, long-term care, annuities, and the hybrids, like I mentioned, just talked about. We're proud sponsors of a number of different fee-only advisory planning firms. So thank you to all of you for tuning in, and we're very happy and proud to be sponsors and be part of all of you all's membership. And we have our Alice system. So if you have any questions about clients' policies, there's a lot of information available at your fingertips. But more importantly, we have 25 people who have emails, have phone calls, or phones, and it's not all automated. We are real people, and we're happy to. Oh, there we go. There we all are. There's all of us real people. So we're happy to help you clients, whether it's questions about existing policies, new policies, or you just want to noodle something out with us about ideas for a client. We're happy to help, and thank you to everybody for tuning in. And I will be talking and emailing with you, and a number of you, I'm sure, soon. And, hopefully you all tune in to Jenny next month. Thank you.